On the Moat Show, we uncover the companies with economic moats, one stock at a time, by bringing on analysts from Morningstar to share their in-depth insights with you.
For today's Moat Show episode, we're covering one of the big three consumer credit bureaus, TransUnion, and we have on Rajiv Bhatia, equity analyst at Morningstar. Rajiv, for those unfamiliar with TransUnion, can you provide an overview of the company's pretty long history, how it's evolved, and its core business lines today?
Sure, and it's great to join the show. So just so folks are familiar, a consumer credit bureau such as TransUnion is a business that collects credit information about individuals. So this is primarily a person's borrowing and payment history. So this would include the amount and type of credit a person has and whether the person makes their payments on time. Before the large credit bureaus that we have today, if you go back 100 years ago, banking was really community-based and relationship-based. If you wanted a loan, there might be some small local independent credit bureau, but lending decisions really could depend on your community standing. You might have someone in your community who could testify to your character, for example. And as you could imagine, lending decisions, wound up being quite subjective. So TransUnion itself traces its history to the late 1960s when it acquired the Credit Bureau of Cook County, and that would be Chicago, which was one of the first computerized information systems in the space. Through acquisitions, TransUnion became a formidable national player and since expanded internationally and across different use cases. If we look at their business today, about 80% of it is US-based. Within the US-based revenue, there's the core lending use case. So, think mortgage, think auto, think card, think personal loans. And then there are other use cases such as tenant screening, employment, government services, marketing. And then they also have a consumer business as well.
Wow, so it sounds like they really do provide a lot of consumer credit data to, a variety of entities across many different sectors. So I guess you kind of mentioned some of the sectors that, sort of buy this data from agencies like TransUnion, but can you kind of talk a little bit, what's this data used for, and why are these parties so interested, in this data for these clients?
Yeah, so the base use case is a lender paying a credit bureau such as TransUnion to get information to make a credit decision. So, think a mortgage lender, auto lender, card lender making a credit decision. Whether someone historically has made their payments on time and how much debt they have outstanding, that has strong predictive validity in making a lending decision. However, for lenders, there are other services the credit bureaus provide. So one would be marketing. Think of a credit card company wanting to target a card to, say, upmarket consumers, or you could have an auto lender wanting to target the subprime space. Another would be fraud and identity. So if you've applied for a loan, you might have run into what's called a knowledge-based authenticator. And that is where you might get prompted with a question such as, okay, which of these addresses have you lived at previously, or something like that. And often those questions are sourced from the credit bureaus.
That's interesting. I mean, the lending aspect is probably what I think of first, but I didn't quite realize that they use it, as far as deep it down as, sort of the prompting of, what address have you lived at, in the past 5 years, and that sort of privacy and protection perspective. So another question I have is sort of given, the inflationary pressures that we've seen pretty much this entire year, or what's been talked about pretty much the last year or two, how has that, sort of impacted the consumer credit data side of things? Have they had to increase the prices of the data that they're providing, and how has that played out within the industry generally?
Yes, I would say historically, their pricing actions, were fairly modest, maybe 1% a year or so. While they do have a wide moat in our view, they are unique in that they have a consortium business model. So their bank customers are also the ones that are supplying them with the data, and large banks tend to be quite sophisticated. In the inflationary environment, they have been able to take more pricing, particularly as Fair Isaac, which owns the IP of the FICO score, has increased prices. So a FICO score is essentially just an overlay on the credit bureau data. So the credit bureaus provide the data input, and then Fair Isaac owns the algorithm. And so this is why someone's FICO score changes depending on whether the data is sourced from TransUnion, Equifax, or Experian. Because FICO scores are based on credit bureau data, they are sold through the credit bureaus. Historically, up until 2018, Fair Isaac never took meaningful price increases as they were content to grow with volume. And, frankly, I think this was a management oversight in my view. However, since then, they've been taking pretty large price increases. And so the credit bureaus have been increasing prices more than Fair Isaacs to keep their margins, and that has resulted in greater gross dollar profits. So just to kind of put some numbers on it and kind of give an example, looking at 2023 versus 2022, FICO scores on a mortgage kind of went from 60 cents per score to up to 270 per score. So with 3 scores on a mortgage, because a mortgage will generally have a credit report from all 3 bureaus, it basically went from $1.80 to about $8 per mortgage. And a tri-merge report for a mortgage, which includes all 3 bureaus and 3 scores, that may have gone from, say, $50 to $75. And we really saw the impact of this in TransUnion's most recent quarter. Mortgage revenue was up 26% despite a 21% decline in volumes.
Rajiv, can you explain the concept of a moat as used by Morningstar in company and stock analysis? Could you also detail how TransUnion meets the criteria of a wide moat rating by outlining its specific competitive advantages?
Sure. So an economic moat refers to a company's durable competitive advantage. So a company with an economic moat can fend off its competitors and get high returns on the capital it deploys. We attribute a moat to a source. So one example would be a cost advantage. If you think about Walmart, say, it has a cost advantage just given its large scale advantage. As it relates to TransUnion's data is critical to loan and underwriting decisions, and the price of its services is negligible relative to the amount of risk. If you just want to ballpark it, you look at the 3 main credit bureaus in the U.S., that would be Equifax, Experian, and TransUnion. They generate about $1 billion or so in revenue from credit card lines of business. Today there's just over $1 trillion in U.S. credit card debt outstanding. If you look at auto loan originations, those are typically over $700 billion per year in the U.S. And auto revenue for all 3 combined is, probably around $600 million. So relatively negligible relative to the amount of risk. I would say, currently it's a pretty stable oligopoly-like structure in the industry. We think there are high barriers to entry that surround the business, as replicating the databases of leading providers like a TransUnion would be difficult. TransUnion's customers, which are the lenders, they're really more concerned about the breadth and accuracy of the data than the price necessarily. So, for example, you could see a lender that may use, 1 or 2 credit bureaus, but if those bureaus don't have much information on a consumer, that would be what's known in the industry as a credit thin file. The lender will then look towards the 3rd bureau. And then the other unique thing about the industry is that the credit bureau suppliers are their customers. So they take data from thousands of financial institutions, clean it, aggregate it, and then repackage it and sell it back to them. So that makes it really hard for a new competitor to come in. So over time, we believe the credit bureaus have created a strong, intangible asset with their data sets and the relationships they have with thousands of financials and banks.
Rajiv, I'm going to talk a little bit about the price action of TransUnion recently. Recently there's been quite a bit of volatility. A lot of it came from sort of a disappointing earnings, release. In October, we saw the share price drop, almost 40% in just that month alone. And I recall at the time reading your update on TransUnion, and you noted sort of the sharp decline as perhaps maybe being an overreaction by the market, and they thought, there might be some value there, some valuation opportunity there. But can you talk, briefly about sort of how TransUnion has performed, in a year and kind of where's the valuation stand today relative to your estimate of fair value?
Yeah, just so our listeners are familiar about what Coulter is talking about. In late October, about 2 months ago, TransUnion reported their 3rd quarter earnings, and they were a bit soft, and they were also reported a disappointing 4th quarter outlook. And as a result, the stock dropped in one day 23%. Since the company went public in 2015, that was actually their worst single day. So just some thoughts there. I would say in general, the market is very jumpy. I've seen stocks when they'll be down 4% after they report earnings, and then for some reason they'll finish the day up 4%. So it does feel like in this market environment, the market just sometimes can't make up its mind. That can present an opportunity to thoughtful investors. So TransUnion stock price, it went from $65 to $50, and then in the following days and weeks, kind of hit a low of $42. Now the stock is about $68. So it can be pretty volatile. And obviously, if you bought the stock at the low at 42, you would have done really well in just a few months. Yeah, I would say TransUnion's 3rd quarter results, they were clearly a big surprise to the market. Equifax had reported the prior week, and they had reported, pretty solid core guidance. TransUnion's management, they talked about a weak September. The credit bureaus have a recurring variable revenue model, or what you might call an embedded transaction-based revenue model. So yes, they do have long-term contracts with their customers, but the amount of revenue they generate is actually based on volumes. So my sense is they just hit an air pocket in September, which surprised them. And given that, they decided to take what's known as a big bath or kitchen sink quarter. Basically, if you have a bad quarter, it's like, why not make it worse? So you fully reset expectations, and then it makes it easier to beat later on. In the quarter, they also took a goodwill write-down for their UK business. They also withdrew their long-term guidance. So in March 2022, right before the market went south, they did give guidance of $5 billion of revenue by 2025. Going into the quarter, we felt that was ambitious. Before they withdrew that, our model was at $4.6 billion. Yeah, I would say since then, like in November, sentiment on the market improved overall, particularly for financials. So that's helping them. We still see upside on TransUnion's shares. We have a $91 fair value estimate, which is based on our discounted cash flow analysis. We think the market overreacted, and we think recession concerns are overblown. Looking at TransUnion's closest peers, we have Equifax as just slightly undervalued, and we have Experian as roughly fairly valued. TransUnion currently trades at about 19 times forward earnings. That's consistent with the S&P 500 index overall. Historically, it's traded at like a 20% to 30% premium. So its valuation is definitely cheap relative to its historical average.
Let's talk more about international expansion efforts, more specifically India. Can you describe what TransUnion's expansion strategy is in India and its expected impact on the company's revenue growth?
Yeah, so about 20% of TransUnion's revenue right now is international. About a quarter of that is from India. So India is TransUnion's largest international market, but it's only 5 to 6% of the firm's entire revenue. After India, the UK, Canada, and Latin America are each slightly smaller. Even though it is only 5 to 6% of revenue, I do think it is worth calling out. One reason for that, it is by far TransUnion's fastest growing segment, growing 30% plus per year, and it's really showing no signs of slowing down. Just given population growth, the size of the market, trends such as the rise of a middle class, we expect it to become more meaningful over time. So over the next 5 years, we expect continued strong growth. 5 years from now, we expect mid to high 20s organic constant currency revenue growth, just given the runway it has there.
Great. Well, beyond some of these sort of more valuation opportunities and growth drivers that all sound great, I want to touch a little bit on risk, that might potentially come up for a company like TransUnion. There's been, as I mentioned earlier, a lot of interest and a lot of concern about interest rates, here in the U.S., and sort of how that might have a delayed effect on the economy and, even the prospects of a recession, next year sometime. So I want to kind of get your view on, how you think these might impact TransUnion, as well as, any other, potential risks that are out there that you're kind of keeping your eye on.
Yeah, so I'll start with interest rates. On consumer lending, the biggest impact from higher interest rates is going to be on mortgage. Not only have we seen home purchase volumes decline quite a bit, but refinances have been very soft, just given the rise in interest rates. You still have some, cash out refis, maybe people taking out home equity lines of credit, but overall refis are down quite a bit. So 2023 refis, they're probably looking to be down around 80% versus 2021 levels. Another thing to consider with interest rate is that TransUnion has a large chunk of variable debt on its balance sheet that it incurred for acquisitions over the years. So in 2023, we forecast interest expense to grow 14% for TransUnion. As interest rates, come down, they should get some benefit from an earnings perspective. You certainly could have idiosyncratic risks such as data breaches or regulatory reviews. If you go back to 2017, Equifax had a major data breach, but they subsequently recovered. The credit bureaus, they have a lot of personal data on people, so they can be somewhat controversial with the public. You sometimes hear complaints, and those regulatory reviews, such as from the CFPB, those can result in settlements. So that's always a risk to be mindful of. I think as far as the macroeconomic environment and to answer the recession question, I think one key learning is that every recession really is different. So, in a quote unquote typical recession, interest rates actually go down, and that's kind of good for mortgage refis. On the other hand, if you have a housing-led downturn, like we saw in 2008, or we have a stagflationary, recessionary environment with rising interest rates, you could see mortgage volumes fall. During the COVID recession of 2020, some non-cyclical items did not perform well due to the lockdown. So tenant screening revenues were weak as consumers were locked down and not moving. At the time, they had a healthcare business that was weak because consumers delayed elective healthcare procedures. I would say if you look at TransUnion's 2009 revenues, it's about 13% lower than 2007. I mean, the global financial crisis, was pretty bad. Definitely a major banking crisis where, banks are really cutting back on lending. Broadly speaking, in any given year, I would kind of view, low single digit organic revenue decline as, a pretty bad scenario. In a bull market, I would expect, maybe 10%-ish, maybe a touch above 10% growth per year. So that kind of gives you an outcome. That kind of gives you a view of what we think the ranges are. In our base case, we kind of expect mid to high single digit revenue growth.
As with any company, there's always some risks out there, on boundaries that you should keep your eye on. But also sounds like there's really some good opportunities in terms of growth drivers, within India and in other, sort of international markets for, a company like TransUnion, as well as, potentially even, a valuation opportunity still, sort of following some of those negative earnings and sort of, earnings reset, as you put it in a way. But Grant, with that, we're out of time, but I think this has been a very insightful conversation. So thank you, Rajiv, for sharing both your time and your insights here with us today. So we would very much appreciate it.
Thanks, Rajiv.
Thank you to all those watching, and see you next time on The Moat Show.
Thanks for joining us on The Moat Show. If you enjoyed this content, consider subscribing to our YouTube channel. Got questions, comments, or suggestions? Let us know in the comments section below. To receive the latest Moat investing research in your inbox, go to VanEck.com/subscribe and select Moat Investing.